Welcome back, everybody. Today, we're going deep on tax strategies, but not just any strategies, the kind that can make a real difference for, high earners like you guys out there. We've got a pretty fascinating mix of sources today, some expert advice from financial advisors, a really interesting case study we broke down, and even some clever tips we found from small business owners.
Yeah, and the cool thing is we're not just going to scratch the surface here. We're going to really break down how to apply these strategies to your own situation. Your specific situation.
Exactly. And you know me, I always love a good surprise.
Yeah.
Well, let me tell you, some of these tax-saving techniques we found are pretty counterintuitive. Like, did you know there's a loophole involving S-Corp that even presidents have used?
It's true. But before we get to those advanced moves, let's make sure we're all on the same page with a key concept: tax arbitrage. This is all about being strategic with when and how you earn and invest your money.
Okay, tax arbitrage. So it's more than just getting deductions. It's about timing, too.
Absolutely. Like maxing out your 401k contributions now doesn't just lower your taxable income for this year. It shifts that income to a future year when you might be in a lower tax bracket, say during retirement. That's when tax arbitrage can really shine.
So instead of just trying to lower my tax bill every year, I should be thinking long term and maybe even embrace paying a bit more in taxes now if it means paying a lot less later.
Exactly. And speaking of retirement contributions, let's not forget about the Roth versus traditional decision. I know you're likely familiar with these, but have you considered how your future tax bracket could make one significantly better than the other?
Well, I've always focused on getting that upfront deduction with traditional contributions. It just seemed like the obvious choice,
That's a common approach, but consider this.
Mm-hmm.
If you're a high earner now, you might actually end up in a higher tax bracket in retirement. If that's the case, paying taxes up front with a Roth contribution could lead to huge savings down the road.
Okay, that's making me rethink my entire retirement strategy. But hold on, we've been talking about 401ks and IRAs, which are great. But aren't there other less common retirement savings options that might be even better for high earners? I mean, you wouldn't believe some of the incomes we've seen come through this podcast.
You're right. There are some lesser-known options that could be a perfect fit. Have you ever considered a cash balance plan?
I've heard the name, but I'm a little fuzzy on the details.
Well, imagine a retirement plan that combines the predictability of a pension with the higher contribution limits of a 401k. That's essentially what a cash balance plan offers. We're talking about potentially sheltering $100,000 to $300,000 per year, depending on your age and income.
Wow, that's way more than I can contribute to my 401k. So why isn't everyone with a high income using a cash balance plan?
That's a great question. They're not for everyone. They come with some administrative complexities and might be better suited for business owners or those with very stable high incomes. But the potential tax savings could be huge, especially if you're looking to supercharge your retirement savings.
Okay, I'm definitely intrigued. So we've covered maximizing contributions to tax-deferred accounts. But what about investments in taxable accounts? I mean, I can't put everything into retirement, right?
You're absolutely right. That's where tax diversification comes in. Having a mix of tax-deferred, tax-free, and taxable accounts gives you options and flexibility when it comes time to access your money.
Makes sense. But when it comes to taxable accounts, it feels like I'm always playing catch-up with the IRS. Every gain, every dividend, it seems like they want to cut. Any advice for minimizing that tax bite?
Absolutely. The key is to adopt a long-term mindset and prioritize tax-efficient investments. Think ETFs and individual stocks over mutual funds, which are known for generating those pesky taxable dividends.
Okay, so ETFs and stocks for the long haul. What else should I be thinking about?
Well, since you're a high earner, tax-exempt municipal bonds could be a fantastic addition to your portfolio. They offer tax-free income, which can be a huge advantage for someone in your tax bracket.
Okay, so I'm hearing a mix of tax-deferred, tax-free, and taxable investments with a focus on long-term growth and minimizing those short-term tax hits. But what about strategies outside of traditional investments?
There are some fantastic options out there, like health savings accounts or HSAs.
HSAs, they're for healthcare, right?
Yeah.
But how can they help me save on taxes?
Think of HSAs as a triple threat. Contributions are tax deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free.
Wait, seriously? So I can deduct contributions, let the money grow tax-free, and withdraw it tax-free for medical expenses? That's incredible.
Exactly. And for someone with a higher income who wants to be prepared for future medical costs, it's an amazing tool. We're talking about a potential triple tax advantage that most people aren't even aware of.
That's mind-blowing. What other tax-saving gems are hiding in plain sight?
Well, have you considered deferred compensation plans? They can be incredibly useful for shifting income to lower tax bracket years potentially saving you a bundle in taxes.
Deferred compensation plan. So I'm essentially delaying a portion of my income to a later date when I might be in a lower tax bracket.
Precisely. That's a powerful technique. But it's important to note that there are some limitations and potential drawbacks. So it's something to discuss with a financial advisor to see if it aligns with your specific situation.
Okay, I'm making a note of that one. Are there any other hidden gems we should be uncovering before we move on?
Well, if you have children or grandchildren, you're saving for college. For 529 plans offer a phenomenal way to do so with some serious tax advantages.
529 plans, right? I've heard of those, but remind me what makes them so special from a tax perspective.
The beauty of 529 plans is that your contributions grow tax-free, and when you withdraw the money for qualified education expenses, those withdrawals are also tax-free. It's a win-win for both you and the future scholar in your life.
Okay, so we've covered a lot of ground already, from maximizing retirement contributions to exploring specialized accounts like HSAs and 529s. But I have a feeling things are about to get even more interesting as we dive into the world of business structures.
You read my mind. For high earners, especially those who are self-employed or own a business, leveraging the right business structure can be a game changer. We're talking about potentially saving a significant amount in taxes.
Okay, I'm all ears. Let's unpack these business structures and how they can help us keep more of our hard-earned money. Where do we even begin?
Well, for starters, let's compare the two most popular options for small businesses, S-Corp and C-Corp. They both have their pros and cons, and understanding the difference is crucial for minimizing your tax liability.
Okay, hit me with the basics. What's the main distinction between an S-Corp and a C-Corp?
With an S-Corp, the business's profits and losses are passed through to your personal income tax return. This means you avoid the dreaded double taxation that comes with a C-Corp.
Double taxation, that sounds painful. So S-Corp helped me avoid that. Why would anyone choose a C-Corp then?
That's a great question. While C-Corps do have that double taxation issue, they offer some unique advantages, particularly for businesses with substantial profits or those planning to go public. C-Corp allow for things like deducting fringe benefits and potentially taking advantage of lower overall tax rates. But they come with more complexity and paperwork.
Got it. So S-Corp offers simplicity and help avoid double taxation, while C-Corp have potential benefits for larger, more complex businesses. But there's that loophole you mentioned earlier, the one even presidents use.
Yes. Remember how we talked about reasonable compensation for S-Corp owners? Well, the IRS requires S-Corp owners to pay themselves a salary. That salary is subject to payroll taxes. But determining what's reasonable can be a bit subjective.
Okay, I see where this is going. So some savvy S-Corp owners might try to minimize their salary to reduce their payroll tax liability?
Exactly. It's a strategy that has been used by many successful entrepreneurs, even those residing in the White House. But it's important to tread carefully here. The IRS is always on the lookout for unreasonable compensation arrangements. So it's crucial to consult with a tax professional to make sure you're on the right side of the law.
Okay, duly noted. So we've got S-Corp and C-Corp, each with their own quirks and advantages. But aren't there other creative ways to use business structures to minimize taxes?
Absolutely. One strategy involves incorporating family members into your business. For example, hiring your children or having them serve on the board can offer some unique tax benefits. Plus, it's a great way to teach them about entrepreneurship.
Okay, now we're talking. So I could pay my kids a reasonable wage for helping out with the business, and that would be a legitimate deduction.
It could be. But as with any business expense, it's essential to document everything meticulously, ensure the work they're doing is legitimate and age appropriate. The IRS isn't fond of sham arrangements, so make sure it's a real job with real responsibilities.
Right. No lemonade stands masquerading as marketing consultancies. Got it. But incorporating family members isn't the only trick up our sleeve, is it? What other business-related tax strategies should we be exploring?
Well, let's not forget about the qualified business income deduction. This allows S-Corp owners to deduct 20% of their business income, potentially saving them a significant amount in taxes.
Wow, a 20% deduction. That's huge. Are there any other S-Corp perks I should know about?
Of course. One of the biggest advantages of an S-Corp is the ability to potentially reduce your self-employment tax burden. By carefully structuring your salary and distributions, you might be able to lower the amount of income subject to those pesky self-employment taxes.
Okay. I'm seeing the appeal of S-Corp more and more. But I'm also realizing that navigating the world of business structures and tax strategies can be pretty complex. It sounds like having a knowledgeable tax advisor in my corner is essential.
You're absolutely right. A skilled tax professional can help you navigate the nuances of business structures, ensure you're taking advantage of all available deductions, and most importantly, keep you on the right side of the law.
Well, I'm definitely feeling more informed, but I also have a lot to think about. So much so that we're actually out of time for this part of our deep dive. But don't worry, we'll be back next week to uncover even more tax-saving strategies, including some creative deductions that you might not have even considered.
Until then, happy saving.
See you then next week. Welcome back to our deep dive into tax strategies for high earners.
Great to be back. Last week, we laid a solid foundation, talking about everything from maximizing those retirement contributions to exploring S-Corp and C-Corp.
We even uncovered that sneaky S-Corp loophole that presidents have been known to use, but we left off on a cliffhanger, promising to reveal some seriously creative tax deductions that often fly under the radar.
Yes, we did.
Sure.
Are you ready to unearth those hidden gems?
Absolutely. Let's talk deductions under the radar strategies that can make a real difference in our tax bills.
Okay, let's start by revisiting the home office deduction. We touched on it briefly last time, but it deserves a closer look.
Yeah.
It's not just for those with a dedicated home office. Even if you use a corner of your dining room table for work-related tasks, you might be able to claim a portion of that deduction.
So if I'm catching up on work emails or finishing up a project at my kitchen counter after dinner, that could potentially count.
It very well could. The key is to determine if that space is regularly and exclusively used for work. You would then calculate the percentage of your home dedicated to this work area and apply that percentage to eligible expenses like rent, mortgage, interest, utilities, and even property taxes.
Okay, that makes sense. But honestly, dealing with those calculations and keeping track of all those expenses sounds like a headache. Is it really worth the effort?
I hear you, but trust me, the potential savings can be significant, especially if you're a homeowner with a hefty mortgage. And remember how we talked about accountable plans? Well, for small business owners, getting reimbursed for those home office expenses under an accountable plan can be even more advantageous.
Right, because those reimbursements aren't considered taxable income, so it's like a double win. My business gets a deduction, and I don't have to pay taxes on the reimbursement.
Exactly. It's a fantastic way to minimize your tax liability and streamline your finances. Now, for something truly creative, let's talk about the Augusta rule.
Oh yeah, the loophole where you can rent your home to your own business. I've been eager to hear more about this one.
It's a fascinating strategy for sure. For up to 14 days a year, you can rent your entire home to your business tax-free. Think about it. Board meetings, team retreats, client entertainment, all potentially tax-free if you structure them as rentals to your business.
Wow, that sounds almost too good to be true. Are there any catches? I mean, the IRS isn't exactly known for being lenient.
Of course, there are some guidelines you need to follow.
Yeah.
The rental income must be comparable to what you would charge an unrelated party, and you need to have a legitimate business purpose for the rental. But if you meet those requirements, this can be a brilliant way to offset business expenses and lower your overall tax bill.
Okay, I'm definitely going to be looking into the Augusta rule more closely. But let's move on to another area where I always feel like I'm leaving money on the table, travel expenses.
Travel expenses. They're deductible for business purposes. We all know that. But there's a specific rule that many people overlook when personal travel is tacked onto a business trip. Have you ever combined a business trip with a few vacation days?
Guilty as charged. Who doesn't love extending a business trip for some leisure time? But I have a feeling that's where things get tricky with the IRS.
You're right. To deduct travel expenses for a trip that includes both business and personal elements, you need to prove that more than 50% of the trip was for business purposes.
Okay, so I can't just tack on a week-long vacation to a 2-day conference and write off the whole trip.
Sadly, no. The IRS is pretty strict about this one. But if you can demonstrate that the primary purpose of the trip was business through meetings, conferences, client visits, and so on, then you can deduct the travel costs as well as meals and lodging for the business portion of the trip.
Okay, that's good to know. I've definitely been a little too liberal with my travel deductions in the past. But let's say my spouse joins me on a business trip, even if they're not directly involved in the business. Any chance I can deduct any of their expenses?
That's a clever thought.
Yeah.
While you can't deduct their expenses simply because they're tagging along, there might be ways to structure their presence to benefit the company.
Okay, now you've got me intrigued. How could I do that?
Think about it this way. If your spouse helps with presentations, takes notes during meetings, or even assists with networking events, you could argue that their presence serves a legitimate business purpose.
So I could potentially deduct a portion of their travel expenses, but I would need to clearly document their role and contributions to the business.
Exactly. The key is to demonstrate a clear connection between their presence and the business activities taking place during the trip. Don't forget, meticulous documentation is essential for any business-related deduction.
You're preaching to the choir now. I'm starting to see how every detail matters when it comes to maximizing these deductions. Speaking of details, let's talk about education expenses. I'm always investing in courses, conferences, and workshops to stay ahead in my field. Are those expenses deductible?
Absolutely. Any education related to maintaining or improving skills in your current trade or business is tax deductible. And it doesn't have to be formal education either. Online courses, industry publications, even travel expenses related to educational events can all be deducted.
Okay, so if I'm a software developer and I take a course on the latest coding framework, that's deductible. But if I decide to go to culinary school just for fun, that's probably not going to fly.
Exactly. The IRS wants to see a clear connection between the education and your current work. It shouldn't be for the purpose of starting a new career or pursuing a personal hobby.
Got it. Now let's switch gears to charitable giving. We briefly touched on this last time, but I'm eager to hear more about how high earners like myself can make the most of charitable deductions.
Charitable giving is not only a fantastic way to support causes you believe in, but it's also an incredibly powerful tax-saving tool, especially for those in higher income brackets.
Okay, tell me more. How can I maximize my charitable deductions?
One strategy to consider is called bunching your donations. Instead of spreading your donations evenly throughout the year, consider making a larger donation every few years.
Bunching my donations. Why would that be advantageous from a tax perspective?
It allows you to exceed the standard deduction threshold in those years, maximizing your tax benefit. You can accomplish this by using a donor-advised fund, which acts like a charitable investment account.
Okay, so I could contribute a large sum to the fund this year, get a significant tax deduction, and then distribute that money to charities over the next few years.
Exactly. It's a smart way to strategically manage your giving and optimize your tax benefits. Another great strategy is to donate appreciated stock instead of cash.
Donating stock, I never thought of that. What's the advantage there?
Well, by donating the stock directly, you avoid paying capital gains tax on the appreciation. Plus, the charity receives the full market value of this stock, making it a win-win situation for everyone.
Wow, that's a fantastic tip. I'm definitely going to be looking into both donor-advised funds and stock donations more closely. But before we move on, I want to hear more about tax strategies specifically for business owners.
You're in luck. We've got a whole treasure chest of strategies for entrepreneurs and business owners, from maximizing deductions to optimizing your business structure.
I'm all ears. Bring on the business-boosting tax tips.
One commonly overlooked strategy is meticulous expense tracking. It's not just about what you can deduct, it's about accurately documenting and categorizing those expenses to support your deductions in case of an audit.
So receipts, invoices, mileage logs, those are all crucial for proving my deductions if the IRS comes knocking.
Absolutely. And it's not just about keeping paper trails. Consider using expense tracking software to automate the process and ensure you're capturing every eligible deduction. There are some fantastic apps out there that can make this process a breeze.
That's a great point. I've been meaning to get more organized with my business finances. Besides meticulous expense tracking, what other areas do business owners often miss out on when it comes to deductions?
One common oversight is failing to capitalize on the depreciation of business assets. Depreciation allows you to deduct the cost of an asset over its useful life.
So for example, if I buy a new computer for my business, I can't deduct the full cost right away, but I can spread that deduction over several years. It's like a slow release tax benefit.
Exactly. And there are different depreciation methods you can use depending on the type of asset and its expected lifespan. Consulting with a tax professional can help you determine the most advantageous method for your business.
Sounds like a good idea. Are there any other depreciation-related tax breaks I should be aware of?
One often overlooked strategy is the Section 179 deduction. It allows you to deduct the full purchase price of qualifying equipment up to a certain limit in the year you place it in service.
So instead of depreciating that new computer over several years, I might be able to deduct the entire cost this year. That could be a huge advantage.
Absolutely. The Section 179 deduction can provide a significant tax benefit, especially for businesses making substantial equipment purchases. It's a fantastic way to accelerate your deductions and reduce your tax liability in the current year.
Okay, I'm definitely adding Section 179 to my list of tax-saving tools to research, but I'm also curious about the idea of hiring family members. You mentioned that as a potential tax strategy earlier. How does that work exactly?
Hiring your children or spouse, if they're genuinely involved in the business, can be a smart way to shift income and potentially lower your overall tax burden. For example, if your child is in a lower tax bracket than you, paying them a reasonable wage for work they perform can lower your family's overall tax liability.
So I could pay my son to help with administrative tasks or even social media for my business, and that would be a legitimate deduction?
It could be. But, as with any deduction, it's crucial to ensure the employment is legitimate. The work should be age-appropriate, the wages should be reasonable for the services provided, and everything should be carefully documented.
Right. Not making up fake jobs for the kids just to get a tax break. Understand. But it sounds like involving family members in the business can be a win-win both for the family and for the tax man.
It certainly can be. And let's not forget about the potential tax benefits of establishing a retirement plan for your business. This not only provides valuable retirement savings for you and your employees, but it also comes with significant tax advantages for the business itself.
Okay, now we're talking. Tell me more about these retirement plan benefits.
Well, contributions to employer-sponsored retirement plans are typically tax-deductible for the business, and the earnings on those contributions grow tax-deferred until retirement.
So it's like getting a tax break now and enjoying tax-deferred growth for the future. That sounds like a great deal.
It is. And there are a variety of retirement plan options available, from simple IRAs to more complex defined benefit plans. The best choice depends on the size of your business, your profit margins, and your long-term goals.
Okay, I'm starting to see the bigger picture here.
Yeah.
It's not just about finding one or two isolated tax deductions. It's about creating a holistic tax plan that encompasses every aspect of my finances, from my business to my personal investments and charitable giving.
You're absolutely right. Strategic tax planning is like putting together a puzzle. You need to find the pieces that fit together to create a complete picture, one that minimizes your tax liability while maximizing your financial well-being.
I love that analogy. It perfectly captures the essence of what we've been talking about. But with so many pieces to this puzzle, it can feel overwhelming. Where do I even begin?
That's where having a knowledgeable tax advisor in your corner can be invaluable. They can help you assess your specific situation, identify potential tax-saving opportunities, and guide you through the complexities of implementing these strategies.
Okay, I'm convinced proactive planning and expert guidance are essential for navigating the tax landscape and achieving long-term financial success. But before we run out of time again, are there any other key takeaways you want to leave our listeners with?
Yes, definitely. I want to emphasize the importance of staying informed. Tax laws are constantly evolving, so it's crucial to stay up to date on any changes that could impact your tax situation.
So even if I think I have a solid tax plan in place, I should still be checking in with my tax advisor periodically to ensure it's still on track.
Absolutely. Tax laws are never static, and neither should your tax plan be. Regularly reviewing your strategy and making adjustments as needed is crucial for maximizing your tax savings and staying ahead of the curve.
Okay, noted. I'm definitely making it a priority to stay informed and be proactive about my tax planning. But alas, we're out of time for this part of our deep dive. However, don't worry, we'll be back next week for our final installment where we'll explore even more advanced tax strategies and discuss how to build a truly comprehensive tax plan that sets you up for long-term financial success.
Until then, happy saving.
Welcome back to our deep dive into tax strategies for high earners. Can you believe we're already on the final part of this series?
Time flies when you're uncovering tax-saving secrets, right? We've covered so much already, from maximizing those retirement contributions to unearthing creative deductions that often get overlooked.
I've learned so much, honestly. I'm starting to think about taxes in a whole new light, not as a burden, but as a puzzle to be solved strategically.
That's the spirit. And in this final part, we're going to take our tax-saving skills to the next level. We'll explore even more advanced strategies and discuss how to build a truly comprehensive tax plan that sets you up for long-term financial success.
Sounds good to me. I'm ready to complete this tax-saving puzzle.
Perfect. Let's start by revisiting business structures. I've already talked about those S Corp and C Corp, but there are other structures that might be even more beneficial, depending on your circumstances. Have you ever considered a limited liability company, or LLC?
Of course, LLCs are very popular these days. I've always thought of them as a good option for small businesses. But how do they stack up against S Corp and C Corp from a tax perspective?
That's a great question. LLCs offer the liability protection of a corporation with the tax flexibility of a partnership or sole proprietorship. This means you get to choose how you want your business to be taxed.
So I could choose to have my LLC taxed as an S Corp, a C Corp, or even as a sole proprietorship.
That's right. This flexibility is one of the biggest advantages of LLCs. They can be a great option for businesses with fluctuating income or for those who want to minimize self-employment taxes. They're kind of a chameleon. They adapt to your specific needs.
That's interesting. I'm starting to see the appeal of LLCs, but are there any other business structures that high earners should be aware of? I mean, our listeners are a sophisticated bunch. They're always looking for that extra edge.
You're right. For high net worth individuals, family limited partnerships or FLPs can be a really valuable tool. They're a bit more complex, but the potential benefits are huge.
FLPs, I've heard the term thrown around, but honestly, I'm not quite sure what they are or how they work.
Well, imagine a structure that allows you to transfer assets to family members while maintaining control over those assets and potentially reducing your estate tax liability. That's essentially what an FLP offers. It's like having your cake and eating it too.
Okay, now you've got my attention. So I could transfer ownership of a property or some investments to my children through an FLP, but I would still have control over those assets, and it could potentially lower my estate taxes. That sounds almost too good to be true.
It can be a powerful strategy, but it's important to remember that FLPs are complex and require careful planning and legal expertise. It's not a do-it-yourself project. Consulting with an estate planning attorney is essential to determine if an FLP is right for your situation and to ensure it's set up correctly.
Okay, I'm adding consult with an estate planning attorney to my to-do list right now.
Right.
But before we move on from business structures, is there anything else we should be considering?
One more structure that high net worth individuals might want to explore is a trust.
Like a living trust.
Exactly. Trusts can be valuable tools for asset protection, estate planning, and even tax minimization. They can provide a level of control and flexibility that other structures simply can't match. But just like FLPs, they can be quite complex and require expert guidance.
Okay, I'm sensing a theme here. Complex financial situations often require complex solutions, and those solutions are best handled with the help of experienced professionals.
You're absolutely right. It's so important to assemble a team of trusted advisors, including tax professionals, estate planning attorneys, and financial advisors who can help you navigate these complexities and create a plan that aligns with your unique goals.
Okay, so we've covered business structures and estate planning, but what about long-term tax planning in general? I mean, we've talked a lot about minimizing taxes in the present, but how do we ensure we're making smart decisions that will benefit us for years to come?
That's a great question. Long-term tax planning is all about thinking ahead and anticipating how your financial situation and tax liability might change over time.
So what are some key considerations for long-term tax planning?
One crucial aspect is understanding your future income streams and tax brackets. If you anticipate being in a lower tax bracket in retirement, it might make sense to defer income and accelerate deductions now. It's like playing 4D chess with the IRS.
Okay, so maximizing contributions to traditional retirement accounts now and delaying withdrawals until retirement when I might be in a lower tax bracket. That makes sense, but what if I expect my income to increase in the future? Wouldn't that change the strategy?
Absolutely. If you anticipate being in a higher tax bracket in the future, it might be advantageous to accelerate income and defer deductions. For example, choosing a Roth IRA instead of a traditional IRA could be a smart move since withdrawals in retirement will be tax-free.
Okay, so it's all about strategically positioning my income and deductions to take advantage of fluctuating tax brackets throughout my life. But besides income and deductions, are there any other factors I should be considering for long-term tax planning?
One often overlooked aspect is the potential impact of tax law changes. Tax codes are constantly evolving, so it's essential to stay informed and adjust your strategies accordingly. What works today might not work tomorrow, so flexibility is key.
So I can't just set up a tax plan and forget about it. I need to review it regularly and make changes as needed to keep up with those ever-changing tax laws.
Exactly. Working with a knowledgeable tax advisor can be really valuable here. They can help you stay ahead of the curve and ensure your plan remains aligned with your goals, even as the tax landscape shifts around you.
Okay, I'm convinced proactive planning and expert guidance are crucial for long-term tax success. But as we wrap up our deep dive, what are some final pearls of wisdom you want to leave our listeners with?
First and foremost, remember that tax planning is not a one-time event. It's an ongoing process. Your financial situation, your goals, and even tax laws are constantly changing. So it's so important to review your plan regularly and make adjustments as needed. Don't let your tax plan gather dust on a shelf.
So even if I feel like I have a solid plan in place, I should still check in with my tax advisor periodically to make sure it's still on track.
Absolutely. And secondly, don't be afraid to seek expert advice. Tax codes are complex, and navigating them alone can be daunting, especially for high earners with complex financial situations. A qualified tax advisor can help you understand your options, identify potential pitfalls, and create a personalized plan that aligns with your unique goals and circumstances.
Right, sometimes it's worth paying for professional expertise to avoid costly mistakes. I'd much rather have peace of mind knowing I'm doing things right. But lastly, and perhaps most importantly, remember that knowledge is power. The more you understand about taxes and the various strategies available to you, the better equipped you'll be to make informed decisions and minimize your tax burden.
Well said. It's not about trying to outsmart the IRS. It's about being proactive, seeking expert guidance, and taking advantage of the tax benefits that are rightfully yours.
Well, I'm feeling much more empowered now, thanks to all the valuable insights you've shared. It's been a fantastic deep dive, and I'm excited to put this knowledge into action.
That's what we like to hear. And with that, we'll wrap up our deep dive into tax strategies for high earners. We hope you found this series informative, inspiring, and most importantly, empowering.
Thanks for joining us. Remember, proactive planning, expert guidance, and continuous learning are the keys to achieving long-term financial success. And until next time, happy saving.
Happy saving.